Okay, I want you to picture a tower, but not just any office building.
Right.
I want you to imagine the tower of traditional finance, the kind of, monolithic structure that casts a shadow over the entire global economy.
You're talking about the heavy hitters, the ones who can move markets just by breathing.
The heaviest.
Yeah?
We are talking about BlackRock. $10 trillion in assets under management.
It's a staggering number.
It really is. That's a 1 with 13 zeros behind it. They are, for all intents and purposes, the landlord of the global economy. Now imagine you're the guy sitting near the top of that tower.
A pretty good seat.
And your specific job is to figure out the future of digital assets for that $10 trillion behemoth.
That is a very stressful desk to sit at. You're describing Martin Bednall.
Exactly. Martin Bednall, he was the head of crypto asset strategy at BlackRock.
Yeah.
So his job wasn't, just checking coin prices or scrolling Twitter.
No, not at all.
It was figuring out how to expose trillions of dollars to this new volatile asset class without getting fired or blowing up the pension funds of half the world.
Right. He had the best seat in the house. He could see the whole regulatory landscape, the institutional plumbing, the client demand. He saw data that you and we just don't get to see.
And then he left.
And that is the real inciting incident for our deep dive today.
It is.
People leave high-powered finance jobs all the time, usually for a beach somewhere or a bigger bonus at a competitor. But Bednall left to place a very specific, a very strategic bet. And the kicker is, it wasn't on Bitcoin.
That's the hook that really got me when I was digging into these sources. Why would someone with that level of insight, someone who helped BlackRock launch their massive Bitcoin ETF, why would he walk away from the mothership to bank specifically on Ethereum?
It's a great question, and I think it really cuts to the heart of where this whole industry is going.
So that's our mission today. We are going to ignore the price charts. We're not talking about going to the moon or, cute dog logos.
Definitely not.
We are looking at the institutional thesis. We want to understand why the so-called smart money is looking at Ethereum not just as a coin, but as the potential infrastructure for the future of finance.
It's a fascinating shift in perspective. If you look the material analyzing Bednall's exit and what he's doing now, a pattern emerges. This isn't about short-term trading. It's about connecting the dots.
Dots between what exactly?
Between the institutional vision, the actual technological capability, and these major economic shifts. Bednall isn't betting on the casino. He's betting on the architecture of the casino itself.
I love that distinction.
Yeah.
So let's dive into the man and his message. Because Bednall's pedigree at BlackRock, that was serious stuff, right?
Absolutely. You have to remember the context of a firm like BlackRock. They are conservative by design.
They have to be.
They manage money for grandmothers, for unions, for governments. They cannot afford to be wrong on security or legality. Bednall's job was to navigate those treacherous waters. How do you touch crypto safely? He was instrumental in the process that eventually led to IBIT,
BlackRock's Bitcoin ETF.
which has been, as we know, historically successful.
So he knows the game. He knows what big players need: custody, compliance, liquidity, all of it. And yet, his personal conviction, where he planted his flag after leaving, is Ethereum. Why? What's the signal?
The signal is that there's a fundamental divergence in how institutions view Bitcoin versus how they view Ethereum. And Bednall's thesis highlights this perfectly. If you listen to the institutional narrative, people like Larry Fink Bitcoin is digital gold.
Or gold 2.0, I've heard that.
Exactly. It's a store of value.
Okay, so you buy it, you hold it. Simple.
Precisely. It's a defensive play. It's a hard asset, a hedge against inflation. You buy it, you stick it in a digital vault, and you hope it preserves your purchasing power. It's passive. It doesn't do anything.
But Ethereum?
Ethereum is viewed totally differently. It's the productive layer. It isn't just an asset, it's a platform. It's where value is worked, where it's invested, lent, transformed. Bednall sees Ethereum as the substrate for capital productivity.
So if Bitcoin is the gold bar in the vault, Ethereum is the factory floor.
The factory floor is a great analogy. Or maybe the electric grid. You don't just hold electricity, you use it to power businesses. Or even better, the internet itself. You don't hold the internet, you build Amazon on top of it.
I see.
Bednall hasn't abandoned the Bitcoin thesis. Institutions love it for what it is, but he's doubling down on the infrastructure play. Betting on Ethereum is betting on the rails that the world's financial value will eventually move on.
Which I'm guessing carries a lot more risk.
Oh, much higher risk. It's a way more complex system, more moving parts. But the potential reward, if it really becomes the global settlement layer, is exponentially higher than just holding a very shiny digital pet rock.
That makes sense. One is defensive, one is offensive, saving versus building. But let's get into the how, because productive layer sounds great, but what makes Ethereum actually able to do this? The sources keep mentioning this phrase, trust machine.
This brings us right to the technical pillar of the whole thesis, smart contracts. This is the breakthrough. It's what separates Ethereum from Bitcoin.
How is
Bitcoin is great, but it's limited. It's basically a calculator. It tracks who sent money to whom. Ethereum is Turing complete.
Whoa, okay, hang on. Turing complete. I feel like I need a computer science degree for that one. Can you translate that for us?
Hey, right. In simple terms, it just means it's fully programmable. It's a computer, not just a ledger. You can write code that actually runs on the blockchain. We call these smart contracts.
Which is kind of a bad name, isn't it?
It is a bit misleading. Think of them more as programmable agreements. They can replicate complex financial and legal logic without needing a person in the middle.
So instead of needing a lawyer to verify that if person A does this, then pay person B, the code just does it.
The code just does it. If X happens, then execute Y. And it does it transparently, immutably, and automatically. And the proof of concept for this, it's already running. It's called DeFi, decentralized finance.
Right.
And people like BUIDL, they look at DeFi not as some Wild West casino, though it can be that, but as a living experiment.
We're talking about things like Uniswap or Aave, right? I see those names popping up more and more.
Correct. Those are platforms built entirely on Ethereum code. Take out Aave. It's a lending market. You deposit assets to earn interest or you borrow against them. But there's no loan officer, no bank branch.
No credit check.
None. It's just code matching supply and demand globally 24/7.
And the numbers aren't small. I was looking at the data from DeFi Llama. Even with all the market volatility, the total value locked, the TVL is consistently in the tens of billions of dollars.
And that's the key metric. It proves real demand. It proves people are willing to trust billions of dollars to open source code. For an institutional strategist like BUIDL, that's proof that the tech works. The rails are operational. The next step is just changing what rides on those rails.
Okay, so right now it's mostly other crypto tokens on those rails. But the sources talk about a holy grail for institutions. Tokenization. That's the buzzword of the year, isn't it?
It is, and for good reason. Tokenization is the bridge. It connects the old world of finance that BUIDL came from with this new world of tech. It's the ability to represent a physical or a traditional asset on the blockchain.
You mean real-world assets or RWAs?
Yes. Imagine taking a U.S. Treasury bond or a share in a commercial real estate building or even a piece of fine art. You create a digital token that represents ownership of that asset on Ethereum.
I have to play devil's advocate here for a second.
Yeah.
Why bother? We have databases, we have paper certificates. Why do we need to put a treasury bond on a blockchain? Is it just to seem cool?
It's all about liquidity and efficiency. Think about real estate. If you want to buy a high-rise, you need millions of dollars and months of paperwork. It's illiquid.
Sure.
But if you tokenize that building, you can sell tiny fractions of it to investors all over the world instantly.
Like buying shares of a stock, but for a specific building.
Exactly, but for anything. And here's the killer app. You can then use those tokens as collateral, that tokenized treasury bond. It can be traded 24/7. It settles instantly T0 settlement, not T plus 2 days like the current system. You could take that token, deposit it into a DeFi protocol like a WAV, and borrow cash against it at 3:00 a.m. on a Sunday.
Wow.
It turns stagnant, slow assets into liquid, moving capital.
That's the light bulb moment right there. It's not about the token, it's about unlocking the value trapped in these slow, old systems. And here's where it gets really interesting. BlackRock isn't just watching this. They're actually doing it.
They are. This is the validation. BlackRock launched BUIDL.
BUIDL.
A very crypto way to spell it, yes. It's their own tokenized fund. It holds cash, U.S. Treasury bills, and repo agreements. And where did they launch it?
On Ethereum.
On Ethereum. That feels huge. When the world's largest asset manager chooses a specific public blockchain for a tokenized fund, they are effectively choosing their operating system for the future. They didn't build their own private chain. They're using the public mainnet. BUIDL saw this coming.
So he isn't just betting on a crypto coin called Ether.
He's betting on the network effects of the platform that BlackRock is already using for its pilots.
That is a massive vote of confidence. But there was a huge roadblock for a long time, wasn't there? The whole environmental issue. Crypto boiling the oceans.
That was a massive barrier, especially for the institutional crowd. You're talking about ESG investors, environmental, social, and governance.
Right.
Pension funds, sovereign wealth funds, they have strict mandates. They literally cannot invest in things with a huge carbon footprint.
And Bitcoin uses proof of work, which is super energy intensive. Ethereum used to as well.
It did. Warehouses full of graphics cards using as much electricity as a small country. That was a giant do not enter sign for corporate capital.
But then came the merge.
September 2022, it was a feat of engineering. I mean, it was like swapping the engine of a jetliner while it was in mid-flight.
Yeah.
Ethereum shifted from proof of work to proof of stake.
Which means they got rid of the miners.
Gone. Instead of solving math problems with electricity, you now stake your capital. You put up your ETH as collateral to verify transactions.
And the impact on energy consumption.
The stats are just staggering. The network's energy use dropped by approximately 99.95% overnight.
99.95%. That's basically throwing it out.
It effectively eliminates the environmental argument. For the smart money, this was the green light. It removed the reputational risk, the compliance risk. BUIDL knows that for trillions of dollars to move onto a blockchain, it has to be ESG compliant. Ethereum just ticked that box.
So we have the tech, the use case, and the green light on energy.
Mm-hmm.
But tech is a brutal game. There's always something newer, faster. Why is BUIDL so sure Ethereum won't get, MySpaced by some new blockchain?
That is the moat question. And in software, value comes from network effects. You could build a better social network than Facebook today, but if all your friends are on Facebook, you're not going to leave.
You go where the people are. And in crypto, the people are the developers.
Exactly. The source material points to reports from Electric Capital, which tracks developer activity. And Ethereum has the largest developer community by an overwhelming margin. It's not even close.
Which creates a cycle.
A powerful flywheel. More developers build more apps. Those apps attract more users. More users mean more money in the ecosystem, which attracts even more developers. It creates this huge barrier to entry.
I have to push back a little. The network isn't perfect. It can be slow. And the fees. I once paid $50 to move $20 worth of something. It was painful. How does that work for global finance?
It doesn't. Not on the main layer. And BUIDL knows that. But remember, he's betting on the future Ethereum. He's looking at the roadmap. The devs have these colorful names for their upgrade phases. The Scourge, the Verge, the Purge.
It sounds like a heavy metal album.
It does. But the goal is very practical. Scalability. And we're already seeing the solution in action. It's called Layer 2s.
Layer 2s. Okay, break that down for us.
Think of Ethereum as the main highway. It's incredibly secure, bomb-proof, but because everyone wants to use it, it gets jammed. Graphic jams mean high tolls.
Makes sense.
Layer 2s, like Optimism or Arbitrum, are express lanes built on top of the highway. They process millions of transactions separately for tiny costs. They bundle them all up, and then they just settle the final result on the main Ethereum highway.
So I don't have to pay the main highway toll for every single thing I do.
Exactly. You operate on the Layer 2, it's fast, it's cheap, pennies per transaction, but you still get the security of the main Ethereum network. BUIDL's thesis absolutely relies on these layers making the network cheap enough for everyday use.
Okay, we've painted a pretty rosy picture. The institutional guy loves it, the tech is evolving, the energy is clean, but this is still crypto. It's risky. What could derail this?
No, you're right, and he'd be the first to tell you that. This is a venture bet. First, there's competition. Ethereum is the leader, but you have chains like Solana, Aptos, Avalanche.
And Solana is fast, very popular.
It is. It's a different approach. It's trying to be super fast on its main layer without relying on Layer 2s. If Ethereum's roadmap takes too long, or if the user experience on Layer 2s is too clunky, people might just go to what works better now.
And what about the tech itself? You said it's complex.
And complexity is the enemy of security. Smart contract hacks are very real. We've seen protocols drained of millions because of one little bug in the code. When you're talking about tokenizing U.S. treasuries, a bug isn't an inconvenience. It's a potential global catastrophe.
And then there's the elephant in the room, the government.
Regulation, the great unknown. What happens if the SEC decides Ethereum itself is a security, or if they ban certain protocols? BUIDL is betting that regulation will eventually provide clarity. Not a ban, but that's a political gamble.
Plus, let's be honest, the user experience is still tough. My mom is not going to be managing private keys anytime soon.
Precisely. For this to reach 8 billion people, the crypto part has to just disappear into the background. It needs to be as easy as Venmo. We are not there yet.
So let's get all home. We have Martin BUIDL, a guy at the top of the financial world at BlackRock, who then walks away to build on Ethereum.
It all comes down to a synthesis of three things. One, technical capacity. The smart contracts, the trust machine. Two, incontestable adoption. The developer moat is just too big to ignore. And three, institutional alignment. Proof of stake and tokenization fit the ESG and efficiency needs of big capital.
He believes it's the engine.
He believes it is the engine of change. He sees a future where stocks, bonds, real estate, money itself all live on these rails.
It really makes you think. The source material ended with a thought that stuck with me. If the man who helped the world's largest asset manager navigate crypto is now looking at Ethereum as the infrastructure of the future, shouldn't we at least try to understand why?
That's the question. This isn't about buying a coin. It's about understanding a technology that might just run the world economy in 10 years. Ignoring it seems like the riskiest bet of all.
And on that note, remember, this is just an invitation to curiosity, not financial advice. We're here to help you understand the deeper currents, not tell you where to swim.
Always do your own research.
Thanks for diving in with us. We'll catch you on the next one.